Welcome to this playlist called How to Invest in Stocks. Yeah, you know what I'm doing? I'm actually kind of Christmas shopping with the family, but hey, I'm bored. So I'm going to cut some videos for YouTube and talk to you. That's right, in this exciting playlist called How to Invest in Stocks. And session 1 is like step 1 of step 20, by the way. Okay, here you go. Don't be shocked. Don't be shocked. You know what? I may make this 10 steps instead of 20 steps. I haven't decided yet. Okay, but here's the deal. Number 1, you got to make money. Just like the 21 Pilots song. Make money. That's right. So there's a couple ways to do it. Number 1, you can get really educated like me and get a PhD in finance, and then they got to hire you because they don't have anybody else with a PhD in finance. That kind of thing, number 1. Or you can have like massive talent, like be incredible at singing, for instance. Yeah, that's one way to do it. But another way to do it is kind of more subtle. You can pick up certifications here and there. Like, for instance, maybe you work for Microsoft at a low level, for instance, and you get all the certifications for hardware, for instance, and move up. A friend of ours did that actually from another company, switched over and now works in Seattle at Microsoft, which is really interesting, right? Another way to do it is, pick up certifications. Like, for instance, you could become a notary and then build a little business around that, doing notarization for attorneys and realtors and stuff like that. The main thing is just be really creative, looking for ways to make money. It's also good to have certifications so that you have multiple different sources of income when you need it. And that's a really powerful lesson that I can explain to you right now. Just make sure that you've got lots of ways to make money. There's different ways. There's things on the internet. You can actually get into sweepstakes and stuff and then take the stuff from sweepstakes and sell it off. There's eBay businesses. But you know what? Make sure that you've got some sort of sound income coming in. Figure out a way for that first, and then try and work out other multiple sources after that. Because a lot of times your secondary sources may be pipe dreams, or maybe you're trying to chase, how to get rich quick schemes, and you're not really being very honest with yourself about that. And that can really undermine your ability to make money through multiple sources of income. So be realistic when you're making income. Focus on making income first. That's the first thing you got to do to be able to invest in the stock market. Here's step 2, and it's not hard to understand. Okay, you went out there and you made income. You got money now. And what you got to do is you got to save some of that money. Now, there's a couple of different formulas you can use. Like, for instance, you can basically save either 10, 15, 20, or 25%, but always make sure that 50% of everything you earn, all your income, goes towards paying your needed expenses. Your light bills, your food, your power, the stuff that you really can't live without. 50%. So, for instance, if you make $5,000 a month, don't let your expenses go above $25,000 of that. If you make $2,000 a month, don't let your expenses go above $1,000 of that. If you make $10,000 a month, don't let your expenses go above $5,000 of that. If you make $1 million a year, don't let your expenses go over $500,000. That's the simple formula. Then the question is what do you do with the other half? Well, if you save 10% in savings for investing, then 40% can go towards fun, going on vacations and stuff. That's the lowest amount of savings I recommend. If you save 25%, then only 25% is left over is going to go towards fun. So if you make $10,000 a month and you've got 25% towards saving and investing in the stock market, then only 25% is left over towards having fun. And you can't blow your money above that amount. That's the easiest way to chop up your money so that you're getting, a good deal on what you're doing. That's the best way to pull it off, is to use this simple strategy of 50% towards the stuff that you have to live on, and then some amount towards savings. 25% is a gnarly number. If you can pull it off, that's the best way to get rich fastest in the stock market, by saving a lot and investing a lot. But there's only 25% left over for fun. So take that into consideration when you're saving to be able to invest in the stock market. This is step 2 of how to invest in the stock market. The third step you have to do is open a Roth IRA. The reason the Roth IRA is so incredibly powerful is because it gives you protection from creditors. And I mean full protection from creditors, much more so than, for instance, certain types of IRAs. The Roth IRA also allows you in certain situations to take money out of the account that you would otherwise pay massive penalties and fees for out of a 401k. The Roth IRA doesn't pay taxes after you get ready to retire. When you're actually distributing the money in retirement, you don't pay taxes on it, and that's an enormous benefit of the Roth IRA that you don't get from other types of accounts. Like, for instance, the 401k or the standard IRA, you do get usually a very small tax deduction when you put money in the account. But when you take money out of the account, then you get absolutely whacked with taxes. With the Roth IRA, it's different. You pay taxes first and then put money in the account. You have to have one open to be able to put money into it. So the third step for investing in the stock market is to get your Roth IRA open. When you do get the Roth IRA open, you'll have full control over your money, because a Roth IRA is a fully self-directed account. If you open it someplace like, for instance, at TD Ameritrade or at Tradier, for instance, any of these online brokerages are going to give you E-Trade is another one, Scottrade is another one. They're going to give you full control over your money. You're going to be able to invest in stocks, bonds, call options, put options, all these different kinds of things that you may need at certain different times in your stock investing, and you won't get in other types of accounts that are not self-directed. That's why your first defense towards becoming very successful as an investor and very secure in your retirement is to open a Roth IRA for you, and then don't stop there. Open a Roth IRA for your wife, and then open a Roth IRA for your kids, and then go around to the rest of your family and see who else doesn't have a Roth IRA open that has money saved that they can put in it. By helping your family create Roths and fund Roths, you yourself are learning how to manage a Roth IRA, and that's an unbelievably important step. The fourth step you need to take to invest in the stock market in this amazing YouTube playlist on the Marisol YouTube channel called How to Invest in Stocks. The next fourth step is incredibly important. You have to participate in your employer-sponsored 401k if it actually makes sense. Now, there's a number of things you need to do to assess the plan and decide whether or not it gives you adequate benefits. Like, for instance, if you have an employer-sponsored plan that doesn't give you matching, that's a bad thing. If you have an employer-sponsored plan that doesn't have an extremely low-cost index mutual fund like the Admiral Vanguard Fund or like one of the Vanguard funds, where the expense ratio should be around 0.02 or less, so in other words, like less than 0.2%, not 1%, not 2%, not 3%, not 4%, and not 5%. So that's what you want to do, is you want to go and look at your employer-sponsored plan, and you want to look for an equity index fund. You want to look for a broad equity index fund, and there's stock, not a bond index. You want to look for a stock index. Examples of stock indexes are the S&P 500. That is possibly the most widely known because there's so many different kinds of financial assets, derivatives, and so forth that come off of that particular index. But there's also, for instance, the Dow Jones index, which is like 30 stocks. There's the Wilshire index. There's the Russell index. There's a lot of different stock market indexes out there. And what you want is an index mutual fund that uses a computer to decide those particular investments. And because it uses a computer, it doesn't have to pay gazillions of dollars of fees so that the fund manager can have a house in New York. You know what I'm saying? So you want to be very, very critical of your employer-sponsored 401k plan. And if you aren't critical or careful to make sure that that plan is a good plan, in other words, they offer you a very low cost, low turnover. That's another thing you want, really, really low turnover. And they have to show you the plan before you get into it. So number one, you want to make sure it has matching. Number two, you want to make sure that it's got a good index fund that has low turnover and low expense ratio. And then you want to make sure there's no surrender costs and so forth. Like, for instance, when you retire, or let's say that even if you don't retire, let's say two other scenarios. Let's say you lose your job, you're laid off. Let's say you quit your job, or let's say you go to another employer. Or let's say that you're actually fired. So there's three additional scenarios. In each of those scenarios, you want to look at the plan and figure out what kind of fees you're going to be hit with in any and all of those scenarios. And if you've got a really good employer-sponsored 401k plan with matching, that doesn't, hammer you with lots of bogus costs and stuff when you leave the employment of that company, then no problem. Go ahead and join it, but only save money up to the matching. So for instance, if they're going to match 5% of your earnings and you make $100,000 a year, then you put in $5,000, they put in $5,000. That's an amazingly awesome deal. So if you have some sort of really hot deal like that, take advantage of it, but only up to the matching. And since you've already opened up your Roth IRA, any amount above that you can save, just put it in your Roth IRA. That's why this step is really incredibly important, which is take a hard look at your employer-sponsored 401k plan and then participate in it if it's a good plan. Here's the next step to becoming a successful stock investor. So you're making money, you're saving money, you've opened a Roth, and you're participating in your employer-sponsored 401k all the way up to the matching. The next step that you want to do is one you want to be really careful with, because a lot of people make a big mistake. They'll go into their account and they'll see a number of different index funds and they'll buy a little bit of each. Don't do that. You want to find the index fund that has the lowest expense ratio and the lowest turnover. The thing is you can do this same thing in your Roth IRA. So like, let's say that you've got $10,000 into a Roth IRA. Well, you should put at least 70% of that into one single index mutual fund. And a good example of a fund that has really low expense ratios and turnover that you can look at on Morningstar is the Vanguard Admiral Fund. VFI as in India, A as in Apple, X as in X-ray, VFIAX. And you'll see that has really low turnover and really low expense ratio. If you have a Roth, though, you don't have to put the money into index mutual funds. You can use ETFs of broad equity indexes. And a good example would be Diamonds. That's DIA. Diamonds, it will put you across 30 stocks, will diversify you across 30 stocks. And once you're diversified across 30 stocks, you can set it and forget it. You don't have to worry about it. You put that money in there and you leave it for decades until you retire and pull it out. And then what do you do with the remainder? Like if you put 70% into the ETF DIA, for instance, then you've got $10,000. What do you do with the remaining $3,000? Well, you can decide whether or not to invest in, for instance, single stocks or call options. And because the single stocks and call options, if you select them correctly, they're going to give you a lot higher return than the averaged out returns of the indexes. We also call the indexes the averages because they average the price movement. So you end up with average returns. If you want above average returns, then you have to get really good at selecting single stocks and trading calls on those single stocks that you've selected correctly. So call options are an even more complicated process because you have to get the stock right, and then you have to be able to select the right call option on that. If you follow these steps, then you're going to set yourself up for the greatest possibility of success of being a stock investor. The next step you have to take to be a successful stock investor is to take a look at whether or not you're making money outside of your salaried income. This is really important because some people make a huge amount of money outside of their regular job. A good friend of mine, Bobby, blues man, works in the largest paper plant in Columbia, South Carolina, and he cleans pools on his side job. And I taught him how to invest in real estate. Now he's a millionaire in real estate because of that side job cleaning pools. A lot of people say, I can't figure out a way to make enough money, to be able to save into an account. And well, the answer may be that you have to work weekends too. And that's what Blues Man did. People who are not afraid to do the extra work to get the extra money in the account are the ones that succeed in the stock market. Now, you may be saying this thing, well, yeah, that's easy for you, if you've got a salary job. But yeah, you got to figure that out. Going back to step one, which is making enough income. What job do you pick? What career do you pick? A lot of times I talk to kids, it's like, well, what are you going to study when you go to college? And if your answer is English, or art history, then you're going to be a poor person because those particular fields of study do not pay. If you tell me you're going to go into engineering, you tell me you're going to go into finance, tell me you're going to go into accounting, any of those kinds of fields, I'm going to go, yeah, maybe there's a shot that you're going to become very successful as a stock investor because you can have a profession that people need and are also willing to pay for. And that's what's really critical to understand. Now, a lot of people don't understand the individual 401k and its counterpart, the individual Roth IRA. And what it is that Congress basically said, you know what, we've got all these doctors and lawyers out there, and they don't have retirement plans. They don't have employer-sponsored 401k plans. And so they said, well, these people can go and create their own self-directed 401k plans. Yes, the word self-directed is exactly what I use. So when you set these up, for instance, at TD Ameritrade, which is where I recommend because they have a large enough legal staff to be able to support your needs in terms of getting the account open and managing it and funding it and then investing through it. They're the only brokerage that has a large enough clout out there to actually, be able to run an individual 401k, an individual Roth IRA. But you're able to put huge amounts of money, large multiples, much more than in the Roth IRA, that you can't that you can't self-direct, for instance, in an employer-sponsored 401k. So the opening, an individual 401k and a Roth IRA, if you have a lot of contract income outside of your regular salary job, is an extremely intelligent move. And there's a lot of people that have this situation, and they're throwing away money in tax dollars because they're letting that money flow straight down to their personal tax return where they get hammered the hardest in taxes. So not only do you get an opportunity to save more into the stock market and invest more by opening an individual 401k and an individual Roth IRA, but you reduce your tax bill because you have to set up an LLC and then do the bookkeeping on that LLC. This is definitely the most advanced part of being a stock investor, which is opening up your own company so you can set up your own individual retirement plans. But if you do that, then you end up with a much higher savings capacity and a lot more money that you can self-direct in the stock market. All right, so now you got your money in your stock investing accounts. You've got your money in your Roth IRA. You've got your money in your employer-sponsored 401k. You've got your money in your individual 401k. You've got your money in an individual Roth IRA. I've explained all that. Now, what do you do with that money? Well, you want to make sure that at least, normally when you start, I recommend that you put 95% of it in an index mutual fund or an ETF, like the Vanguard Admiral VFIAX, the Vanguard 500 Fund VFINX, or the Diamonds, the ETF DIA, which diversifies you across 30 Dow stocks, or the S&P 500 SPY Spider, which diversifies you across 500 stocks. 90% of your investment money should, at the beginning, or 95% should go into that, and then 5%. So like if you got $100,000, you put $95,000 into the S&P 500 or the Dow 30 through the Spider or through the Diamonds, and then you can take $5,000 and try trading call options on that. If you lose that money this year, just save money into your retirement accounts. Do the same thing next year. 95% goes into DIA or SPY, into an index mutual fund or ETF. Lowest turnover, lowest expense ratio, and then $5,000, 5% if you had $100,000 you were investing, would go into calls. That way you're not getting into trouble. You're not putting like $95,000 into calls and $5,000 in indexes and then get hammered and lose all your money because it was all in calls. Now, a more aggressive stance when you become more experienced in investing in single stocks and calls would be to put 90% into indexed investments and an index investment, just one, an index ETF, an index mutual fund, and then 10%, in the case of a $100,000 example, $10,000 into options. Now, the maximum that I recommend anybody even try would be 30%. So 70% in indexed stuff, 30% into call options. That'd be a $100,000 account with $70,000 in indexes and $30,000 in calls. But you better get it right. You better know what you're doing, because if you blow out that $30,000, it's going to be very difficult for the index side of that particular portfolio to catch up the loss on the call side. So that's a strategy. Again, think of your ratios. You look at your investment money and say, okay, 95-5 plan would be 95% into an ETF, an indexed stock something, and 5% into calls or options. And then the most risky would be 70% into indexes and 30% into calls. That would be the riskiest. That would be really gunning the throttle, and don't go above that. If you'll do this, even if you wipe yourself out in your call investments or your single stock investments, you'll still save your butt with your indexed investments. That's why I use a combined core satellite approach where I've got a large percentage into index mutual funds and then small percentage into individual stocks and or call options, generally call options. You know, you may have heard about call options and how you can get rich quick in call options, and that is true. There's no doubt about that. But you can lose every single dime you put in them overnight. So you have to balance the trade-offs of the extreme riskiness of calls against the lesser riskiness of shares. Now, that said, you can buy shares in a stock that's worth $5 and have that thing drop to $1 and end up with just as large of a loss on some of your call positions. So don't think that being over in single stocks is going to be less riskier than calls. In general, your single stocks are not going to drop as much as your calls are. So you're going to find out that your call options are going to tend to be the riskiest positions that you've got in the stock market, but that's not always the case. There can be some cases where you're investing in IPOs and some other kinds of single stocks where you can have overnight drops where you can, go from $20 to 50 cents or something. Some really crazy things like that can happen in single stocks. So, don't underestimate the riskiness of single stocks, but don't be terrified of the much higher risk in general of call options. That much higher risk of call options also means that you can make a lot of money extremely fast because of the higher risk in call options. So I do encourage you to at least learn about call options and even maybe test out some trades in call options. Just make sure that's very small amounts of money. Go back to the last lesson and look at what I was talking about having, especially at the beginning, say 95% of your money into indexed ETF kind of investments. Investments that don't drop a lot when the market drops a huge amount. And in the case of the question of, okay, now I've got my money into index stuff, and I want to get some riskier stuff going. Should I do stocks or should I do calls or should I do both? Well, the question really to be answered is determined by how much knowledge you have. If you're very knowledgeable and you really do understand the mechanics of call options, but maybe you never traded them, then you should trade them, right? Because you've got the knowledge and you will understand what's going on when the trades are unfolding. And it's the only way that you're going to get experience in trading call options is to actually trade them. I know that sounds crazy, but it's true. So if you do understand call options, which a lot of people don't, then take a shot at it and see if you can be successful as a call option trader. Other than that, you can get your feet wet owning shares of larger stocks that aren't as likely to drop, substantially when something happens. Okay, this is a really, really important lesson, and I'm going to talk about volume, value, momentum, IPOs, and why these are the most important things that you can do to determine whether or not a hot stock is going to rise and if it's going to continue to rise. Volume. Why is volume important? Because when people are buying and selling, it runs orders to the market. That shows up as volume that's coming up underneath the chart. And so what you want to do is make sure that you're only buying stocks that have good volume. And then when the volume comes into the market, you want to see the price shoot up on that volume, and then you know that it's buying volume that came into the market, and that's going to push the stock price up. So that's the very first thing that we're looking at when we want to know whether or not we've got a good stock to buy or not. Now, value is another really good one. A couple of years ago, I knew, for instance, that Monish Pabrai, a big value investor, had owned a particular stock. It was called Fiat Chrysler. It had gone from $14 down to $4. And then it had been in this long downtrend for over a year. And then it broke that uptrend and went shooting up from really high volume. And then the price continued to rise. I knew for a fact that that was buying volume because of that particular pattern. And it allowed me to make a lot of money on a value play because I was able to shade and fade Monish Pabrai. Warren Buffett's another big value player. And if I know that he's in that stock and that stock does the right things, then I'm going to buy into that stock because I know that stock is really likely to rise. Now, a couple of other ways that I make really good money in the market is I look for IPOs. An IPO is an initial public offering. When that initial public offering comes into the market, usually they drop. And you only want to look for initial public offerings that have been profitable before they went public. Jay Ritter, a professor of finance at the University of Florida, shows that these stocks have a tendency to come in. Often they'll rise up and then they drop, they collapse. And so you want to be really cautious with IPOs. The vast majority of IPOs are dogs. Even the ones that look really good have usually got some sort of flaw. Like, for instance, in one of the videos I was talking about Peloton. And Peloton has got all these guys from Harvard and UT Austin and Columbia and, these Stanford and stuff that they've got on their staff. But you look at their age, they're really young. They're young, dumb, and full of, something. So at least the guys are, right? They're overconfident, and so they'd made this big mistake. They didn't license the music, and now they're getting hammered in lawsuits, and they could lose the company. The company could go bankrupt over that. So IPOs is a great way to make money, but it takes a lot of research and analysis and a lot of thinking to make sure that you're investing in the right IPO. If you will look carefully at these particular anomalies, you're looking at value when it's really low, and then who's in the stock and what's it doing in terms of volume, and what's it doing in terms of momentum, which is the trend. Whether it's trending up, that's positive momentum. Whether it's trending down, that's negative momentum. Looking for IPOs, stuff that's just come out of the market. If you will focus on this cluster of ways that indicate that the stock is rising really well, this is going to make you most successful in actually selecting the hottest stocks in the market. Okay, let's talk about, this is the last lesson, it's lesson number 10, and let's talk about commodity ETFs. Remember I talked about exchange traded funds where they'll take and they'll buy a bunch of shares of an index, stocks in an index, and then they'll let people buy into that fund by issuing shares out of the fund. That's an ETF. Now they can do the same thing if it's a commodity by buying futures contracts. Like they can buy futures contracts in gold, they can buy futures contracts in silver, they can buy futures contracts in oil, they can buy futures contracts in gasoline, they can buy futures contracts in copper. So you can track these commodity ETFs, and instead of taking a lot of risk in the futures market, you can buy either shares of a commodity ETF, like for instance you can buy shares of oil when it's rising in an oil ETF, and you can buy, if you really want to lever it, you can buy calls to try to make money faster, with the caveat that, calls can also, you can lose every dime you put in calls, so you want to make sure that you're not putting too much money into the market that way. So commodity ETFs are a really great way to take advantage of physical commodities and actually invest in those types of assets that would be virtually impossible to do. You'd have to go out and trade futures, which would be potentially a much more difficult way to make money out of the market. Now, the next thing that I want to talk about is bonds. So, like if you make a lot of money, you're worth say 5 million or 10 million because you've done really well in the stock market. You can buy individual bonds. Do not buy bond funds. Don't ever buy bond funds. Buy the individual bond. If you've got a self-directed Roth IRA, self-directed individual 401k, self-directed individual Roth IRA, you'll be able to buy the bonds directly and own them directly and just earn the interest directly. Don't ever buy annuities. Annuities are issued by insurance companies, and they are just as bad as bank CDs, because the only thing the insurance company wants to do is basically bring in the money by selling you the annuity and then use it. That's it. They could care less about whether you succeed. Annuities have really horrible surrender fees. Another really big problem with annuities is you've got to read all of the documents really, really carefully to find out where they're going to screw you. Because 9 times out of 10, the annuity is going to screw you. In fact, 100 times out of 10, the insurance company is going to screw you with annuities. So don't buy annuities. Buy bonds rather than annuities. And the other thing is don't do a reverse mortgage if your house is cashed out. Sell the house and put the money in the bank. Reverse mortgages are absolutely horrible. They're horrible for you, and they're horrible for your heirs. Look very carefully, and you'll see what I mean about how bad reverse mortgages are. If you'll follow these 10 steps of how to invest in the stock market, you're going to set yourself up for the best possible odds of becoming a stock market millionaire.